Welcome back to an unconventional approach to financial self-reliance. Today we're going to be talking specifically about leveraging your relationship with the bank. You know, as we work with banks, we have two relationships. One is we are either a depositor or, on the other side, we're a borrower. Now, as a depositor, we put our money in the bank where it sits virtually idle, and the bank has control of that money. As a borrower, we take out a loan and we pay interest to the bank, and as soon as we pay that first payment and each subsequent payment, the bank immediately loans that money back out again, and that's what we call the velocity of money. I think you'd agree that in either one of these relationships, the bank is at a distinct advantage. Let's look at the process we use in banking in the conventional way, and that is that we receive our paycheck or whatever form of income we have, and we place that, as I said before, in the bank where it sits idle until we need it. And then when we need it, we use it to pay our mortgage payment, among other things, all of our bills and expenses throughout the month. So if we look at an unconventional approach to banking, where we're going to bypass the bank as much as possible, we're going to take our paycheck this time, and instead of depositing it into the bank, we're going to make it go directly against our mortgage, thereby lowering our balance by the amount of the paycheck, in this case $5,000, and we now have a balance of $145,000 on our mortgage. Now we're going to take a line of credit, a credit card or a HELOC or a signature loan, any kind of line of credit, and we're going to use that throughout this month to pay our regular expenses. As we do that, obviously the balance on our credit card is going to go up, and in this case we'll say that it goes all the way up to the limit, which is $5,000. And so at the end of this month, we've got a $5,000 balance on our credit card, but our mortgage balance has been reduced by $5,000. As we move to the second month and each subsequent month after that, we're going to do things a little bit differently. Now we're going to take our paycheck, and before the interest is due and has accrued on our credit card, we're going to pay off that balance or our line of credit. We're going to pay that balance off, and that thereby reduces it back down to zero with our $5,000 paycheck. Now, throughout this month, we're going to once again use the line of credit to make our monthly expenses, including our house payment and everything else that we pay. As a result of this, of course, our credit card balance is going to go back up until it gets back up to $1,000, to $5,000. Now, you can see that you can repeat this each month. The next month, you get your paycheck and you make a payment against your line of credit before the interest is due, and lower your balance, and you just repeat the process. Now, as a result of changing the way that we bank and now leveraging the bank, we are going to be able to identify in this scenario that we've saved $22,000 in interest, and we also have cut 2.5 years off the time on this mortgage, and at $900 a month payments, that saves another $27,000, and so total savings is just under $50,000. And here's the important thing. We did all of this without spending any additional money. All we did was change the process and leverage the bank. To learn more about this and any of our other unconventional strategies, we invite you to contact us at this information below.